Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike York. Today is Friday, and it's September 7th. Hope you guys are having a great day today and even better weekend plans coming up ahead. Hey, we got a couple economic news releases to go over today, and these are the big ones actually for this week, and those are the BLS jobs reports. So we'll start with the non-farm payrolls for the month of August. So the last 2 months were revised a total of 50,000 jobs. They're revised lower. So July's number came in at 147. Forecast for August was 200,000. I mean, pretty much kind of came in line with with the estimates. Some cases were maybe a little higher than estimates. Some were a little bit lower, like anywhere between estimates were ranging anywhere between 185 to 200,000. So depending on which estimate you're going off, they're maybe slightly better than what they were. But with that revision there, it's obviously that kind of hurts things a little bit here. And then we also got the unemployment rate here for the month of August. So in July we had 3.9. Forecast supposed to dip to 3.8, but it remained at 3.9. And the reason being is that the participation rate, the labor participation rate shrank a little bit. So we had people applying, about 400,000 people applying for unemployment, but we also had about 400,000 people that dropped off the labor participation level here. So that's why it remained 3.9 from July to August here. And last but not least, we got average hourly earnings for the month of August. So in July, we had a 0.3% increase. Forecast was supposed to be a little bit more moderate at 0.2, and it actually came in a little higher at 0.4%. So what does this mean? It shows that employers are paying their employees a bit more money to retain them because the market is so tight that now we're starting to see the year over year is about 2.9% here. This is the highest increase in about 9.5 years, almost 10 years here on this. Now, what does this translate? This translates that basically they're going to be really watching this a lot more carefully. As we've been talking about that, people probably start making more money because employers, there's just not enough people out there that are able to fill the positions, so they're trying to keep their employees from going off to other people. And to do so is to pay them more money. Now, what that also means is that as we're experiencing here on the Fed level, the Fed has been raising interest rates and to keep inflation in check and basically keep some ammunition or some tools in their tool chest, because at this point, if anything happens, they don't really have anything to sustain any shocks to the economy. And that was even kind of reported by one of the Fed members yesterday, as well as the other one, Williams, who is actually the vice chairman, and he carries a lot of weight. Basically, what he had stated that is that even though the rate hikes may create a flat to inverted yield curve, that alone should not concern them. So that means that these rate hikes are on the table, and that yes, we're expecting one this month at this month's meeting, but now the December meeting probably will increase. That means we'll have 1% of interest rate hikes just this year alone, and there's at least 3 more projections for next year in rate hikes. So if we do go to a recession, the only thing in their tool chest really is to try to reduce rates to try to stimulate the economy. That's the only thing they really have in their tool chest at this point, it seems like. So this is what, as you'll see, the bond market, how they're going to react here in a bit as well. So the stock market's a bit mixed. The Dow is in negative territory. There's talk about, even though job numbers aren't really playing much role into it, what's really playing more of the role is again, more discussion on more tariffs on Chinese goods. So right now, there's about $200 billion on Chinese goods, and now they're talking, and President Trump tweeted that they're looking at aiming another $260 billion of more tariffs added to that. So it'll be a total of 467, I believe, in tariffs to be applied towards. Obviously, that's going to be exceeding what the deficit we have with China, and it'll be interesting to see how this plays out with China. So this could lead to a bit more in the trade war, so to speak, or add more fuel to the fire, so to speak. So we'll have to kind of see how this plays out, but the markets aren't liking it, and the Dow is actually down over 100 points so far this morning. Now, on the news of the inflation, as you can see, the bond market is taking off in a negative territory. We're down about 30 basis points. We're currently right about the line or the floor of support. It's been a pretty strong floor of support, but as you can see, we're testing with that little little wick down just below it, and if we break below that, we have another 25 basis points to lose. So rates have worsened today. We do have a worsening in our interest rates today, unfortunately. But if we can have this floor of support hold, we have some possibility where we can rebound a little bit. But again, it's on inflation talk on there. 10-year Treasury is taking off, so a lot of that the yields are rising. So we're up to about 2.94 right now. As you can see, we're touching about 2.95. We just pulled back a little bit. We're down to about 2.94 right now, and just basically breaking above the 100-day move. Looks like the 100-day moving average right here. So again, we have to be careful here in these range because rates could worsen a bit further. All right, folks, I hope you guys have a great rest of the week. But if you guys want to come over to Twitter, you can follow me there. I do post throughout the day on Twitter how the market, any changes in the market. Otherwise, enjoy your day and have a great weekend. We'll see you guys on Monday. Thanks for watching. Bye-bye.